All right, let's talk about the big picture from this week. It seems to be pretty accommodative. The bulls joining us for the discussion. Kevin Gordon kicking things off, senior investment strategist at Charles Schwab & Co. Good to see you, Kevin. Stocks at 5,000 in the S&P. Tech still carrying us?
So far, yeah. I mean, I think not just the price action, but if you actually look at some of the earnings action, a lot of the mega caps, and if you move up the cap spectrum, that's been responsible for a lot of the estimates moving higher, at least for the fourth quarter. And it's still the case for, much of this year, but it's not really just a price story. It's also an earnings story too, which I think is part of what has helped us kind of build the momentum and sustain that momentum really for tech and everything sort of tech adjacent for the market itself.
Okay. The breadth outside of it, the Russell's still kind of stuck. Are we learning that that's not a problem, or is it just not a problem until it is? I mean, the market seems to be okay post earnings with just tech doing the work.
Yeah, I mean, I think for small caps, what's been harder, and it's a little bit more nuanced as we've gone into this, I guess, post-Fed pivot, environment where, still, if you look at the relationship between interest rates and stocks broadly in the large cap space, that relationship has gotten a little bit less hostile, where you don't really have as deep of a negative correlation between bond yields and stock prices, meaning every time you get a lift in yields, it's not putting as much downward pressure on large caps. But that's not really as much the case in the small cap universe. You're still seeing much more interest sensitive parts of that market, which is probably not a surprise, but I think is emblematic of where we are in this cycle and where a lot of the, sort of expectation is on the market's part and on investors' part that small caps are still probably going to have a lot more to struggle through. Not as much to the downside, I think much more in a sideways move, because that is what earnings estimates have done. That's what the broader Russell 2000 has done. I think it's also, again, emblematic of where we're at for price action with the Russell 2000 still being somewhere in a bear market, even as large cap indexes have moved higher. So that split has now been much more defined, I think, based on that interest rate and stock price relationship.
Yeah, you guys have done a really good job on the equity research side there, explaining that to us and setting us up to be ready for that relationship over the last 8-9 months. Speaking of bonds, we got Cooper Howard in the mix, Director of Fixed Income Strategist. Slide on in. All right, Cooper, we had a bond auction today in the 10-year. How'd it go?
It went really well. It was pretty strong. It was actually the largest 10-year auction that we've ever seen in history. So I think coming into it, there was a lot of concerns of if this increase in issuance is going to attract a fair amount of demand and what that means for yields. And what we saw is that it did attract a fair amount of demand. So I think that that's a positive for the Treasury market going forward. We've always kind of been in this camp that the market will be able to absorb the increase of issuance. So we don't think that it has that too big of a impact on yields. And it looks like today's just a data point to help reiterate that point.
Bonds had a pretty wild week last week, super strong, then had to give it up after jobs, and then had to give it up again on the ISM. But there's this kind of regional bank concern lingering that seems to be helping support the bond market. As far as credit goes, Cooper, do you see connections between some of the strength in treasuries in connection to that regional bank fear?
Yeah, you're right. You see kind of, if you look at the Treasury market, we're really caught between this, I'd say, push, pull, tug kind of market that we're in right now, to where we're seeing yields push higher because of stronger expected economic growth. We're also seeing yields pull lower because we're starting to see a lot of Fed officials push back against the timing of interest rate cuts. And then also just concerns over the size of issuance. Like I mentioned before, we don't think that has too big of a concern out there. But I think if you look at the direction of Treasuries, it wouldn't be too surprising if we continue to trend a little bit in a sideways channel going forward. Overall, we think that it's likely that we'll probably see lower yields, but we'll probably see a little bit of volatility and choppiness going forward, Oliver.
All right. Thinking about chop and bonds, it looks like as long as it happens under a certain level, it's okay for stocks. As we talked about, Kevin, the connection between the Russell generally seems to be where that sensitivity is in rates. What are you looking for in the next half of this earnings season? If that's kind of what's the most important thing right now, Kevin, what are the main highlights we should be aware of?
Yeah, I think from a fundamental perspective, the revenue picture has come more into focus and should probably have more of an emphasis. And that's actually the split that you've seen, not just in the fourth quarter reporting season, but over the past couple quarters has been this beat rate, which has been pretty healthy on the earnings side, but not as much on the revenue side. And I think, a lot of that is really the sort of the effect of cost cuts and relatively aggressive cost cuts on the parts of companies and being able to, whether it's via layoffs or input costs coming down or a combination of the two. And that's fine for this part of the cycle. It's pretty normal what you see after you go through somewhat of an earnings recession. But you're at the part of the cycle now for some companies that have gone through that stress to now see revenue growth kick back in. So I think that that's going to be a more important component moving forward, especially because you don't have the inflation wave to deal with like you did a year or two ago, where companies aren't going to be able to benefit any more from that and raise prices because of inflation. Now you have inflation less of an issue, especially on the goods side of the economy. And I would look to actual organic revenue growth now picking back up. If that's not the case, I think it's going to be a lot harder. But for now, you have a lot of the headwinds, for the top line that have receded.
Yeah, good stuff. All right, good point. Differences in revenue when you're forced to hike prices versus out of convenience and demand. Thanks, guys. Good conversation. Kevin Gordon, glad we got you. Cooper Howard, thank you, guys.